Welcome back. You are tuned in to Traders Nation. Thanks for staying with us. My pleasure, as always, have Mike Larson with us here today. Mike, welcome to Traders Nation. How are you today?
I'm glad to be here. How are you?
Good, Mike. Listen, if the cost for capital for Fannie and Freddie goes up, will mortgage rates go up?
Yeah, that's essentially the bottom line. When you distill for the consumer what all this chaos means, Fannie and Freddie debt spreads widening out and Treasury rates going up on some concern of the cost of billing them out. But the bottom line is it would tend to make mortgages more expensive. I mean, after all, Fannie and Freddie essentially are the mortgage market now. Between them and they're about 75-80% or so of the mortgage securitizations being done right now.
Okay.
And you throw in FHA, and that's pretty much the only game in town. So you got to keep a close eye on what happens there.
All right. So you say 78% of the mortgages are going through Freddie and Fannie right now?
Exactly. If you look at the securitizations being done, the bundling and selling of these mortgages as bonds, Fannie and Freddie account for about 75-80% of the volume right now. All that subprime and all-day stuff is gone. So that pretty much means they're the only game in town when you're looking to get a loan.
All right. So what's going through them now is different from the capacity that they hold, which is a little bit over 50% of the United States mortgages, correct?
Yep, that's right. This is the new volume versus what they already have in their books.
Oh, they already have in their books. Okay. Now, it looks like, and this is news coming out, it looks like that they're going to be trying to raise $10 billion. Now, Mike, I don't know about you, but this is kind of a problem considering their market cap's only about $6 billion.
I'll tell you, this has been one of the most interesting weeks I can remember in a long time. Conveniently, we banned the short selling in the same week that all these banks need major capital. They come out with earnings. You backstop Fannie and Freddie, and now, what do you know? They're looking to raise capital after they have this huge stock market rally. Not trying to put my tinfoil hat on here, but it seems awfully coincidental. And hey, maybe if they have any sense about them, they should get out there and sell as much as they can while they've got this rally. And I think the same holds true for a lot of the other banks that are on the ropes.
All right, Fannie Mae saw a low around, I'm guessing around 665, I think it was. Currently trading up around 1370 today. Nice double. Did they already start raising money yet?
Like I said, I would be on the phone to my buddies on Wall Street and hitting up every fund manager who's been riding this thing down for the last year and see if they're willing to cough up a little more cash.
Yeah, interesting. All right, so what does this mean to the shareholder? Obviously, it's not a good thing. We're going to see dilution here.
Well, absolutely, and and again, I'd love to say that they finally solved the problem and this is over and isn't that great. But if you look at a chart of Fannie Mae or Freddie Mac or almost all of these financials, go back to what happened in late November of '07, or you go back to the Bear Stearns bailout. I mean, we've seen this movie before. You get these big panic washouts, and something happens to save the day. They rally, and they kind of mess around for a little while, and then new low, a few months later. So I'm kind of skeptical that this is the end of it because I don't think the housing and mortgage markets are on healthy ground still. All
right, so they dilute onto the shareholders. They raise the money. Do we still need a Fed bailout?
Well, the idea is to hopefully not need that. I think that's what a lot of the stuff that happened in this past week is to try and be like, okay, can we get some private money and not have the government have to step up? But again, if the economy and the housing market are still in a downturn a year from now, and if the problem in prime mortgages keeps getting worse, which that's actually the biggest thing that jumps out at me out of the shareholder calls this week. You listen to Citigroup, you listen to JP Morgan, they both say that it's the prime mortgages that are starting to go south at a much faster rate. So that's the bread and butter of Fannie and Freddie, which leads me to believe that eventually some kind of concrete taxpayer support is probably going to be involved.
All right, so what are we looking at? In the end, what are we looking at? Obviously, within the last, 4 or 5 trading sessions, if you saw the bottom on Fannie, if you saw the Fannie on Fannie, Mike, you would have saw potential of a nice reversal.
Yeah, if you were smart enough or risky enough to jump into the breach when they were falling apart and you made yourself a quick double, I'd just take the money and run. And I think the same goes for a lot of these banks. I mean, the action is just simply astounding to see a company with the market cap of a Wells Fargo or a JP Morgan to go up 30-40% in a couple days. I mean, but the reality is, again, Wells Fargo, you look at what happened back in January of this year, same thing, this big decline, huge rally, but in the longer term, did it really mean anything? No, because the problems haven't gone away.
All right, let's talk about banks. I've been asking everybody this. We're all interested in finding out, is our bank safe? I mean, you saw a run on banks in California, and everyone's like, okay, well, where can I get real information? I don't want to talk to the bank manager because, of course, he's sweating it over there, and he may give me disinformation, saying, yeah, no problem, don't worry about it, go home, drink a Coke, which is down. So is there a place that we can go to see if our banks are safe? Now, I understand, Mike, yes, you probably would, if you were a bank, you probably wouldn't want to be on a list anywhere because you don't want no one running onto your bank, but there's got to be some information somewhere compiled. Your thoughts?
Yeah, well, absolutely. Now, first off, let's just say this. If you have FDIC insurance, you're not talking about over $100,000. I mean, it's more of just a hassle issue than it is a safety issue. I mean, you look at what happened to IndyMac, your bank fails. I mean, all those people who have insured deposits are going to get the money back, but they got to stand in line a day. There may be technical glitches and that kind of stuff.
Yeah, but what if they have over $100,000, though? Because let's face it, I mean, $100,000, hey, that's a good chunk of change, but people are going to have more than that in there, which then means you have to wait if you get anything at all thereafter.
That's right, and that's why it's more important now than it's probably been in 15, 20 years to start paying attention to your bank safety. And there are a couple independent companies out there that do bank ratings. The Street.com has a ratings group that publishes A through F safety ratings for banks that consumers can go to. There's a company called Bauer Financial that has, a star rating scale, 0 to 5 stars, that does the same thing. So that, if you're a consumer, you've got, enough money that you're looking at potentially worrying about uninsured deposits, go to one of these companies, you pay a nominal fee, $15, $20, whatever it is, you can get that safety rating. And, that's a small price to pay for the peace of mind, in my opinion.
Yeah, without doubt. Now, did you say Bauer Financial?
Bauer Financial, Bauer Financial. They're right on the web at www.bauerfinancial, or like I said, thestreet.com. They have a ratings group that does this similar business. So it's a small price to pay for peace of mind.
Yeah, I agree with you on that one. All right, parting thoughts here today. Which we look at financials in the next 3 months. What can we expect?
Well, again, I look at what happened here, and it feels great. It's wonderful. You want to say the worst is over. At the very least, I think you got to retest some of the lows. See if they're going to stay put. And at the best case scenario, again, if this still sticks, it's going to be a while before you can overcome all that overhead resistance on a technical basis. So if you made the money that in these past few days, I'd probably take it and walk.
Take it and run.
Take it and run. There you go.
Take it and run. And put it in maybe another bank. All right, there you have it. Mike, where can we find you at?
Moneyandmarkets.com is where I write. My day of the week is Friday, and I've just been covering all the stuff that's going on.
Perfect. Mike Larson, folks. Of course, you can find him at moneyandmarkets.com. Mike, have a great day. Appreciate it. All right, moneyandmarkets.com. Head on over there today and then check out all that free information that they have. Not only Mike Larson's there, but a lot of great other columnists, writers are over there with great free information. You can't beat that. Moneyandmarkets.com. Head on over there today.